Hi, and welcome to our newest installment of our series, Dollar Cents. In this series, we seek to shed light on the institutions, the practices, and the dynamics that make up our financial system, both local and global. And to help us through this thicket, we are again going to be relying on the expertise and knowledge of Joe Camargo with Platinum Wealth Partners. And Joe will continue to serve as our guru as we explore our financial system. And I don't know, when I think about dollars, I think about banks. So let's talk about banks today.
Sure.
And specifically, we're all familiar with walking into a bank or writing a check, et cetera. What is the purpose of our local banks, really?
Well, in its simplest form, a bank is a facilitator of capital and currency. What does that mean? It's a place for someone to take their hard-earned money and deposit and hopefully have the bank safeguard the savings. It's also a place where we can all go and apply for a loan if we happen to need capital for a purchase of an automobile, or of course the house, the mortgage. So those are the two basic functions that the bank, again, in its simplest form, strive to maintain and meet.
Mm-hmm.
Yeah.
So, I mean, if I, as a worker, I end up hopefully with a little bit more money than I'm spending at the end of each month. That's what everybody's aiming for. A bank, as my father would always have said, would have been the place to put that. Is that the same kind of viable alternative these days for my savings? Can I expect them to grow in the bank? Or
excellent question. The way I would answer that, at least initially, would be, and we kind of have to talk about interest rates on some level. Banks traditionally will pay you a certain amount for holding your funds with the bank, right? So what they're doing is they're paying you for access to your money, and typically, well, it's interesting right now, but right now, to answer your question directly, the traditional savings account or money market pay almost nothing because interest rates on a national level, and in fact on a global level, are at historic lows. So the days where you might go to your local bank and receive 7 or 8% on a savings account or a CD, those days we're not there quite yet. So again, right now a bank is not a place where you might consider to grow your savings. It's more of a place to kind of park your savings, receive perhaps some safety of principal through the federal government, through an FDIC sort of program. But
because the government insures, right, as I understand it, deposits that I would make into a savings account at the bank, the government will insure that deposit up until a certain level. Is that right?
Up to a certain level, and it's going to depend on how the account is registered and the number of accounts that you have and that sort of thing. But there is that attraction in having the government insure your deposits up to that dollar amount. Mm-hmm. The interesting thing, though, is, as you said, or as you asked, why is it not something that I might consider in terms of placing my money? And again, it all boils down to interest rates. And as I said a minute ago, interest rates are at historic lows. So people are starting to look elsewhere for that yield, for that additional growth that you used to, and in some cases still do, receive through a traditional banking institution.
Mm-hmm. And while I don't want to spend too much time talking about interest rates per se, you did mention earlier that you thought they might be heading back up. You said we're not there yet in terms of getting back to a 5, 6, 7% return.
Right.
Will we ever be? Do you see that ever being the case again?
Yes. The short answer is yes. Our economy goes through a economic cycle. Free market systems go through different phases of growth and contraction. And having just exited a massive period of contraction, this great recession that everyone talks about, interest rates have been kept artificially low by our central bank, the Federal Reserve, with the aim and hope of further stimulating the economy. So what the Fed does, in effect, through a variety of different mechanisms, is it injects money into the money supply into the economy, keeping rates low. And by virtue of rates being low, that's going to entice, theoretically, businesses and individuals to go out and borrow. When you borrow, you multiply the dollar effect, and over time, the economy expands. We see growth within several different sectors. And once you have reached a level where growth is, or the dollar supply in this case, has exceeded the demand for goods and services, you arrive at inflation. Mm-hmm. And once inflation has reared its ugly head, interest rates generally start to rise, and the attractiveness of a savings account, which right now might be 0.1% in that area, it's much more attractive given that inflation has resurfaced. And right now, inflation, depending on who you talk to and the sort of data that you're looking at, is very benign. It's very modest, and it's not something that people are right now fearful of. Mm-hmm. But as we, again, make our way up the economic cycle, interest rates historically tend to rise. And once they start to rise, again, inflation becomes more apparent, and savings accounts will pay more. On the flip side, mortgage rates on the lending side, those will also increase. So it's a very tricky balance that the Fed has to maintain in terms of monitoring interest rates, keeping them at levels that will continue to spur economic growth, mm-hmm.
Maintaining
what's called full employment, which may be...
okay, actually I'm just going to stop you right there, because I want to bring us all the way back to talking about the local banks, because
Sure.
You just mentioned, again, you said on the lending side, mm-hmm. and that reminds me that obviously you mentioned that banks are both a repository for our money, a place where we can put our money safely, as you say, even if it won't grow that mm-hmm. much, but also a place where we as consumers can go to get money. That's right? And how does that part of the banking system work in terms of consumers and businesses, let's say, that need money? What do you obviously I could walk into the bank and say, I need money. Right. What else do I need to show in order to be able to get money from that bank?
Okay, excellent question, interesting point. The industry has established a number of guidelines that both individuals and businesses really should meet before they are considered creditworthy, right? Obviously, income, your payment history, the capacity, any collateral that you might have, those are all criteria. Your debt-to-income ratio, for example, all separate but combined sets of criteria that the bank will take into account before it decides to lend you X number of dollars, whatever you're looking for. Mm-hmm. So there is a screening process, and there was some concern that the screening process, not to go too far off subject, but the screening process had kind of receded a little bit pre-recession. And once the recession took hold, there was an enormous vacuum, a lack of credit. A credit freeze is what people typically refer to during the recession, and that was because the economy was so weak, being on the lower end of the economic cycle. So now that the economy has strengthened, not necessarily operating on all cylinders, but now that it has strengthened, its credit requirements have kind of eased up a little bit, mm-hmm. and people that might not have had access to credit 2 or 3 years ago are now able to obtain that credit and meet whatever goal they're looking to accomplish.
So that is beginning to happen now, because I
Yes.
understand from friends and just from reading and hearing things in the press that while banks are not necessarily going to give us a great return on the money that we deposit there, it is also, we are not yet finding as consumers that they're that willing to lend us money. But you're saying that that's getting better as we speak?
It is getting better. If you were to look at credit standards in 2009, 2010, right after the recession officially ended, with respect to your credit score, your FICO score that people oftentimes talk about, you had to have what was called an A credit rating just to kind of be looked at, principally because banks were so anxious and reluctant to lend money given the state of the macroeconomic environment. Now that things are better, you do see a lot of both small and large institutions, as I said, easing up. And you see that evidenced in the number of automobiles that are purchased and the number of refinances that are taking place right now. Clearly not at the level that we were at back in 2005, 2006, but with respect to the auto sector, we've made incredible progress. With respect to the housing sector, not quite so much. Clearly, again, not at 2005-06 levels, but at a point in time where I think people are feeling much better about their overall financial situation as well as their overall ability to garner credit.
Great. Well, since we're thinking about the banking system as a system as well, I wanted to move from this level that we've been talking about of our consumer interaction with the bank and businesses, let's say small business owners or even growing businesses, relationship with the bank in terms of securing financing and et cetera. I also understand that there is, but don't understand how it is composed, that there is a relationship between banks, that banks do business with each other. I was wondering if you could elucidate, how that part of the system works a little bit.
Absolutely, yeah. It's an enormous network. If we just focus on the United States banking system, for example, I read an article recently that talked about the fact that we, about 3 decades ago, went from roughly 18,000 federally insured banks to about 6,800. So the initial inclination or the initial question is, well, why? That is a combination of, if we go back again about 20 years, we had the S&L crisis, which was also housing related on another level. An enormous number of banks ceased operations for financial reasons, but also, and I think perhaps more to the point today, there's a great deal of consolidation taking place within the banking industry altogether. The fact that intrastate banking or interstate banking is now a possibility. There are a number of larger banks that are gobbling up the smaller banks, and so as a result you see a smaller number of banks. So again, that number went from roughly 18,000 to about just under 7,000. Those banks all are part of the Federal Reserve Network. And the Federal Reserve is a term that's used every single day. I hear it every single day in the office, and people ask me, well, what's the Fed? Well, the Fed is the Fed.
What's the Fed, Joe?
Okay, so the Fed is our central bank. In fact, it is, I believe, no, it is our third attempt at a central bank for the country. We had one attempt in 1791, which didn't work out quite so well, another one in 1816.
So I know those were called Bank of the United States, right? I remember that
First
from
Bank
my
of the
own
United
history,
States, second
lessons
Bank of the
and
United
teaching,
States.
et cetera.
Correct.
And so those have evolved into what we now call the Federal Reserve.
The Federal Reserve, which was the act was passed into law in 1913, and the Federal Reserve was created in 1913 to address some of the issues that these previous iterations had, as well as provide some confidence and stability to the American public. Pre-Federal Reserve as we know it, you had a number of different currencies. You had a number of different regulations, both interstate and intrastate. And what the Federal Reserve was designed to do, among many other things, was to eliminate that duplicity, eliminate the uncertainty, and again, create confidence. So the way that the Fed does that is by, well, a number of things, but one, it has a dual mandate, and the dual mandate involves price stability and full employment. Along the lines of those two major mandates, it has to regulate its smaller banks, its member banks, which you alluded to. It also has some transactional or financial services responsibilities that it meets on a very daily basis, processing checks, transferring money, that sort of thing. So if we use one of your banks as an example, if I'm a member bank and I need to borrow money, I'm not going to go to an individual, I'm going to go to the Federal Reserve. So what the Fed does is it establishes a target, or what people refer to as the Fed funds rate, and that rate is what it charges, or it assesses its member banks for overnight overnight loans. That's the essence of the interconnectivity between the Federal Reserve and its member institutions. Member institutions also obviously have to maintain a degree of solvency. They need to maintain a certain amount of capital on reserve. But it's, as I said, it's an enormously large and somewhat complicated subject.
So I got the impression from what you were just saying, which was a pretty clear explication, I have to say, of what seems like a very complicated system all around. But I got the impression then that it is not as if banks actually borrow from each other, but instead that they would be borrowing from the Fed. Is that?
They can, but no, that's not to say that there's a restraint against interbank lending and interbank activity. Certainly there is. But typically the best rate that one can garner is through the Fed, right? Especially if it's an overnight rate. Where the Fed is responsible for controlling the money supply and controlling interest rates, it would stand to reason that you're going to the Fed to borrow funds. So no, I didn't mean to lead you in the wrong direction.
No,
Banks
not at all.
certainly do borrow from one another on a very daily basis. Yes.
Okay.
Yeah.
And I just would like to ask for a little bit more clarification even on what you're referring to as the overnight rate, which I know is the rate that gets quoted the most, that we hear a lot of the time about whether it's going up or down. Does that literally mean that banks are securing money from the Fed overnight?
Okay. Yes and no. I mentioned a moment ago the responsibility that banks have in terms of reserve requirements. Banks have and in fact, the reserve requirements post-recession have in fact strengthened through a number of different initiatives on the part of the industry and in fact on the part of the government. But
to ensure that banks have more money at hand to be able to meet their obligations.
Yes, but also to ensure that, to build off of your point, to ensure that they meet what's frequently called or referred to as a stress test. If we're ever in the situation where our banking system is in a near collapsible state, which we were this close to a massive global depression. My opinion, which is shared by a number of people within the industry. So in order to combat that fear and promote stability within the system, the Fed has again required that these banks meet that requirement. If during the course of daily operations they've lent out and taken in money and they no longer meet that reserve requirement, they will go through the system and borrow the funds needed to ensure that they are at that percentage, at that reserve number that's required of them by the banking system regulatory bodies. Is that better?
Yes.
Does that make sense?
Yeah, absolutely. And I'm going to just throw one more kind of very concrete way of thinking about this at you, and then you tell me how accurate or inaccurate it is. In fact, when you talk about the reserve that a bank or a bank or a bunch of banks would have to have in order to meet the stress test requirements, as you say, is that a reserve that's there in the theoretical, very small possibility that everybody panicked and went into the bank and wanted to take their money back out? Is that what that is about, or is that too simplified a notion
No, I think
entirely?
that's a good explanation, good overview of what it is. I mean, the days where, and this kind of builds off of our conversation from the first segment, our currency, our dollar, is no longer tied to the gold standard. And because it's not tied to the gold standard, if we were to go back in time and there was a run on banks, let's say that there was a geopolitical or economic event that caused people to go to the bank and want to withdraw all of their money. Banks typically either didn't have the actual assets on file, the commodity, the gold bullion that was used to redeem the notes that the government put out, and that was very problematic, which is the primary driver in terms of why we were taken off of the gold standard, allowing the Federal Reserve to print and print and print money as it thought necessary. So the fact that there is a reserve requirement, I think, is two parts. One, to kind of assuage individuals from thinking that, oh my God, if there is that run, I'm not going to be able to withdraw my savings. That's no longer a, well, it's always a fear, but it's not a fear that's linked to an actual commodity. But the other, I think, and perhaps equally important reason is that, look, again, we just exited this massive recessionary period. We want to make sure that our banking system is sound. And a way in which to do that is by increasing the member institutions' reserve requirements, so that if there is a situation where the bank has made an investment or two that didn't pan out according to how they had hoped, now they're looking at a balance sheet that maybe isn't quite as sound as it was in the past. So having that additional buffer of reserve kind of not only makes the Fed feel better, but also makes the general public feel better, and dissipates just a little bit the notion of too big to fail. That was one concern that many people had, and many people still have, is, oh my God, what happens if this one institution fails at managing its own finances? What sort of a ripple effect will it have on the economy? So to kind of allay those fears, those reserve requirements have been expanded, and so far so good.
And you know what? I feel better too,
Okay,
now that
good.
you've explained that. That's great. So we have now talked about our local relationship with banks, and then the national system to some degree, at least as it relates to the Fed and to banks in the inter and intrastate banking system. That leaves one level yet to discuss, and that's the global level, of course, as we talked about with currency last time. So how is it? I understand that it is not just individuals and businesses that need to borrow money or to save money and have it grow, you know, through interest, et cetera, but obviously public entities, municipalities, governments at every level, including national governments. And so there is clearly an international banking system as well. And one of the names that is most prominent, I think, when anybody thinks about the international banking system is the International Monetary Fund. The
IMF, yeah.
Yeah, the International Monetary Fund. And we often hear about it and its practices or policies. What are its origins? What is its purpose? And how does it function, really?
Okay, the IMF is one of a number of international, truly international organizations that was created to foster economic growth, global economic growth. So you have, for example, you have the IMF, you have the OECD, which is the Organization for economic cooperation and development. These are these are organizations that have, instead of member institution banks, you have member institution countries, all of which play a role in, again, fostering economic growth. So you have countries, for example, that, like the U.S., that have some very clear responsibilities in terms of funding the IMF, in terms of ensuring that its contribution or contributions are being directed in the right direction. And by that, I think most people mean emerging countries. Most people, you hear the terms thrown about emerging countries, advanced countries, advanced markets, industrialized markets, emerging markets, frontier markets. We are clearly the world's financial engine. There's some discussion in terms of whether or not we will remain the world's financial engine, but for now we are it. There are other countries that clearly have a say in terms of how the globe operates and how the overall global economic machine operates. But the U.S. is it. So my point is this. At one time, we were a frontier nation. And from a frontier nation, we developed into an emerging nation, an emerging market where we were just starting to put the infrastructures in place, highways, that sort of thing, markets, right? And now we're clearly one of the world's, or the world's largest economy by GDP standards. There are countries across the globe that are still very much frontier nations, and then there are emerging markets that are still very much emerging markets that are looking to take the next step. The IMF and the OECD are organizations that look to take these nations and allow them to develop into what we would consider in the West more advanced. So that in effect is the purpose of these sort of nonprofit institutions, is to create markets and to advance not just the economies, but also the way of life for millions, or in fact billions of people across the globe that are still, if you can believe it, without water and without very basic necessities that we here, I think, take for granted in the West, not so much the U.S., but that are very much a premium in developing nations.
So I would imagine, though, that the IMF, similar to the way that the Federal Reserve, for instance, if we just go back to that for a second, sounds to me like the Federal Reserve has two things going on, two major things going on in its relationship with regional banks or smaller banks, as you say. And that is, it is both a source of money given at a relatively low, or lent at a very low, relatively low rate to them, but also, as you said, with stress tests and with reserves, et cetera, it regulates. It dictates to some degree the terms under which the banks can operate. Right. Does the IMF have something similar going on in the way that it deals with the people or the countries, et cetera, that it is helping? So in other words, it's supplying money to aid in their development, but is there a flip side in terms of, you know, it also dictates terms to those countries?
Yes, absolutely it does. It's not an ATM machine of sorts. I mean, clearly the IMF has another goal outside of economic development, and that is human development. So what it is looking for, in addition to the economic growth, is human rights growth. And so I believe, and correct me if I'm wrong, this isn't my strong suit, but clearly there has to be some criteria in place that would require that institution, the institution that's borrowing from the IMF, to look, I need to meet this criteria. Otherwise, that capital that I am so in need of is not going to be there. Mm-hmm. So political development, economic development, social development, those are all requirements that would really need to be there for me as the IMF to want to lend member institutions capital.
And thank you for joining us for this new installment in Dollar Cents. And we look forward to tackling the next issue the next time. We'll see you then.